What's up? Today I'll be talking about what is possibly the easiest way to invest, target date funds. Target date funds are mutual funds or ETFs that are structured to grow assets in a way that is optimized for a specific time frame. They are for investors that are saving towards a future expense, usually retirement, but also for other things like saving for a kid's college fund. These target date funds periodically rebalance the weighted asset classes to optimize risk and returns for the stated time frame. This is typically a gradual shift from a more aggressive portfolio seeking capital accumulation to a more conservative portfolio seeking capital preservation, so as to minimize risk when the target date approaches. They do this so you don't have to, basically autopilot for easy investing. So like literally, step 1, you choose your target date. Step 2, you put money into the fund. There is no step 3. Very simple. But on this channel, we like to do a deep dive into things. So we'll take a look at some examples to observe how their portfolio composition changes over time. We'll look at some good ones. We'll take a look at some bad ones, because not all target date funds are created equal. Some of them are beautiful. Some of them are so bad that I want to karate chop the TV. We'll talk about the pros and the cons of this strategy, and at the end, I'll give my own opinion, because I am the expert of my own opinion. But at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, feel free to lurk down below and check out the links in the description. You can get free stocks, free crypto, also a free $30 to sign up with Rakuten, a site where you can earn cash back on everyday purchases. Without further ado, let's get started. Alright, let's look at some examples. I've gone on Fidelity and filtered the funds to only include target date funds. Let's sort by expense ratio. This is the annual cost that we have to pay for management. The gross expense ratio is the total percentage of a mutual fund's assets that are devoted to running the fund, while the net expense ratio includes trading costs, as well as any reimbursements and waivers. So we'll talk about transaction fees later. Let's look at the highest cost first, and I'm just going to say it. All these fund issuers should be ashamed of themselves. I'm triggered. Charging a 2% expense ratio for a target date fund is criminal, basically highway robbery. The name of the game is to move money from your clients' pockets to your pockets. The market averages a 7% return when adjusted for inflation. And as investors get older, they de-risk, thus reducing their expected rate of return even below that. So if you are paying a 2% management fee, like I said, it's criminal. I usually save my opinion for the end of the video, but I couldn't control myself. All these expensive funds get a 0 out of 10 from me. Ideally, what we are looking for is an index target date fund. These funds follow an index and are passively managed as opposed to actively managed. Therefore, they have lower management costs. So alright, let's lower my blood pressure and let's sort by lowest expense ratio. The Fidelity Freedom Institutional Premium Target Date Funds only charge an 8 basis point expense ratio. However, they have a $5 million minimum to invest. These are really intended for the retirement plans of large employers, not for us poors. So you might find these funds in your 401k, but we will focus on the investor grade target date funds because they either have no minimum to invest or a much more reasonable minimum to invest. And most of us don't have $5 million laying around. Let's look at the Fidelity Freedom Investor Class Target Date Index Funds as our example. They have a $0 minimum to invest and charge a 12 basis point expense ratio. A 12 basis point expense ratio is more expensive than the typical total market or S&P 500 index fund, which is usually down around 3 or 4 basis points. But I would say that 12 is fair for the simplicity that these funds have to offer. But we do have to be careful when it comes to cost. Even small differences in cost can compound into large differences over time. This calculator shows the concept. If you invest $6,000 a year into two funds, one with a 0.12% expense ratio and one with a 1.89% expense ratio, assuming equal returns of 7% annually, at the end of the 40 years, the 1.89% expense ratio fund would cost nearly $500,000 more. Absolutely insane. You could buy a Lamborghini Aventador with those cost savings. But before we look at portfolio compositions, let's briefly discuss asset allocation and risk tolerances. The general rule is this: the younger you are, the more risk you can afford to take because you have more time to recover from a downturn. The older you are, the less risk you can afford to take because older individuals have less time to recover from a market downturn. Therefore, retirees tend to focus more on safe and stable income-producing assets as opposed to those that seek aggressive capital accumulation at the cost of higher risk. This is essentially transitioning from the wealth accumulation phase to the wealth preservation phase. This chart gives us an idea of what a conservative portfolio looks like when compared to an aggressive portfolio, and also everything in between the two extremes. We would expect our far-out target date funds to look more aggressive and our more near-term target date funds to look more conservative. So let's look at the 2065 target date fund. This is for the young investor who is just getting started. We see that it is about 90% stocks and 10% bonds. When we check in on someone who is mid-career, say maybe the 2045 target date fund, we still see a similar asset allocation. Let's look at someone 10 years further along with the 2035 target date funds. Here we see some de-risking start to occur. This fund is now about 20% bonds. At the time of this video, the 2025 target date fund is currently for someone who is only a few years away from retirement. So we see 40% bonds. The 2015 fund is for a retiree, so it's even more risk off. 50% bonds and 10% treasury bills. When we look at the 2005 fund, we see the de-risking still continues even after retirement. It is 60% bonds and 15% treasury bills. So in summary, the asset allocation tends to stay similar until roughly 15 years before retirement. It looks like we also have some low-cost index investor class target date funds from Vanguard and Schwab. Granted, both of these have a $2,500 minimum to invest, but if you can get over that, the Schwab fund only charges 8 basis points, which is more competitive than the Fidelity investor class funds. The State Street Global Advisors, T. Rowe Price, and BlackRock investor-grade target date funds are less competitive on costs, but again, I'm referring to the investor class funds, not the cheaper institutional funds that you may see in your 401k. These providers will all have slightly different asset allocations from each other, but the general de-risking principle will be the same among all of them. You might have noticed the transaction fees on the screen. A transaction fee is a flat charge that you may have to pay each time you buy a mutual fund, but more commonly if you buy a competitor's fund. For instance, given that I'm using Fidelity, I would have to pay a $75 transaction fee to buy a Vanguard target date fund on Fidelity. Vanguard is great and all, but I would never do that given that buying the Fidelity fund on Fidelity is free. Meanwhile, buying the Vanguard fund on Vanguard would have no transaction fee. So what are the benefits of investing in target date funds? The quick answer is just how easy it is. It really is set it and forget it investing. A target date fund can literally be the only investment that a person needs to make. And you can't mess it up either, as the de-risking process is automatically managed for you. One can simply set up automatic, recurring investments, dollar cost average, and not worry about it. This is the most stress-free way to invest, and it takes the emotion out of things. Emotion and impulsive action is not your friend when it comes to investing. Consistency, proper asset allocation, and keeping a long-term outlook is the winning strategy. Typically, investors do better when they don't try to overmanage their investments. Fidelity once did a study and found that the best investors were either dead people or people who forgot about their accounts. Think about it. Dead people don't trade, FOMO, paper hand, or try to time the market. Dead people are the ultimate buy and hold, diamond-handed investors. So let's move on to the downsides. The obvious downside is the lack of customization. Investing is not necessarily a one-size-fits-all approach. For instance, a lot of 20-year-olds don't want to hold bonds at all. They have their entire investing life ahead of them. They can afford to take risk, and therefore they may want to be 100% in equities. But one thing I will point out, investors will sometimes choose a target date fund according to their own risk tolerance. For instance, if an investor is seeking to take more risk, they might buy a target date fund that is 5 to 10 years later than their actual planned retirement date. Additionally, target date funds don't allow for an investor to strategically place their investments to optimize for tax efficiency. For example, bonds are generally tax inefficient because the interest they produce every year is taxed at the full marginal tax rate. Contrast this with holding equities. Investors only pay tax when they sell a stock for a gain or receive dividend payments. So an investor may want to keep these bonds in a tax-sheltered account, but the equities could stay in a taxable account. A target date fund does not afford an investor with this flexibility. This flexibility comes even more important when an investor moves into retirement and is looking to optimize their distributions for tax efficiency. So there can come a point where an investor might actually outgrow the target date fund and would benefit from a more customized strategy. So another downside is cost. The index target date funds are pretty cheap, but you are still paying a slight premium for them. VTI is an ETF that tracks the US stock market and only charges 3 basis points. VT is an ETF that tracks the total world stock market and it charges 8 basis points. The target date funds that we looked at did hold international equities, so they are very similar to VT at least until the last 15 years before retirement. So you can make the argument that you are paying slightly more for mostly the same thing, at least for a while. You could really build your own target date fund with just a combination of VTI, Vanguard Total US Market, VXUS, Vanguard Total International Market, and BND, Vanguard Total Bond Market, or just VT and BND. This is if you want the customization and if you're willing to do the work. Another downside is that at least as of now, target date funds are all mutual funds. There are currently no target date ETFs, although I assume there will be at some point. Both ETFs and mutual funds hold portfolios of stocks, bonds, commodities, etc. However, ETFs can be bought and sold intraday like a stock, while a mutual fund can only be bought and sold at the beginning or end of the trading day. ETFs tend to have lower costs than mutual funds. ETFs also tend to be more tax efficient because they have a unique method of doing transactions that provides fund managers with an additional tool to minimize the distributions of capital gains. They can do an in-kind exchange of securities so that the fund is not selling securities for cash and therefore capital gains are not incurred. But I don't want to get too far into the weeds here. Some people like mutual funds over ETFs because they can automate investments and buy partial shares. But pretty much any respectable brokerage allows for the purchase of fractional ETF shares, and some allow for automating investments into ETFs. In addition to the other perks, many people like ETFs more because they can watch them trade throughout the day and they like being able to buy whenever they want during the trading day. However, there is definitely a danger with ETFs if you are prone to impulsive day trading, which usually causes underperformance. So bottom line, mutual funds are for boomers. Don't buy them unless you are a boomer. I'm kidding, but also not kidding. So what are my thoughts on target date funds? I like the general idea. I think it makes a lot of sense for investors that really don't want to pay attention to their investments, and investing doesn't interest you. That is completely okay. All you have to do is understand the value of investing, keep your fees low, and the target date fund can do the rest. Most of the time, it is better to focus on your career, focus on increasing your income and increasing your savings rate, and keep the investing nice and simple. Just focus on maxing out those 401ks, IRAs, and HSAs. You will become very wealthy over time. Target date investing is the easiest, most hands-off approach to investing. However, I don't personally own any target date funds, and it's probably because I'm a control freak and I want to control my asset allocation, for better or for worse. My main issue with the composition of most target date funds is that most of them have young people in their 20s holding bonds. Investors in this age demographic have so much time ahead of them, they can really lean into the risk premium that equities have to offer. I just feel as though that is really wasting the years where the opportunity cost of your money is the highest. And at that age, you can really take advantage of the full power of compounding interest. A 20-year-old can have an 88x multiplier on their money just because of the amount of time they have ahead of them in the market and the kind of risk they can afford to take. I'm sure plenty of investors would disagree with my take on this, but at the end of the day, everyone has their own individual risk tolerance, and an aggressive portfolio means different things for different people. For instance, I also hold crypto, and my crypto portfolio swings like 30% every other week. Some people just can't handle that. I keep a long-term outlook. I don't mind volatility as long as I'm holding a diversified portfolio of quality investments. Volatility can provide opportunity. However, some young investors choose to hold bonds specifically so that they can sell them to buy stocks when stocks get crushed. But again, a target date fund would not allow you this flexibility. My other issue is cost. I'm a cheapskate and I want to keep my fees as low as possible. Again, 12 basis points is cheap, but I would rather just own the broad market for 3 basis points and deal with the de-risking process when the time comes. Fidelity also has some free mutual funds. But if you found this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently, down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, $50 of Bitcoin with Celsius where you can earn interest on your crypto, and also $30 with Rakuten where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.